As you can see, the 10-year is just constantly making new lows right now. We have a fresh forecast from Goldman Sachs, reversing a position really, talking about 1% on the 10-year. We have Stephen Englander saying definitely 2 Fed cuts by June. What say you?
As you know, Vonnie, I've been saying for quite some time the 10-year yield is going down. I think it was 150 was my target. We have beaten that. We have gone below. And I think 1% and going 1% below the 1% figure for the 10-year, I think is very much there in terms of expectation for the 10-year yield. The 30-year, I think, would go to the 150 level. These both would be unprecedentedly low figures. As far as the Fed is concerned, I've always believed that the Fed reacts to the stock market. It is not really oriented toward the economy or inflation. When the stock market corrects, as it did in late 2018, the Fed pivoted from talking about 3 rate increases in 2019 to 3 rate cuts in 2019. So I'm expecting 3 rate cuts. One of them could be a 50 basis point cut. And I think Fed may at some point restart quantitative easing in terms of starting to buy bonds, and that would push the 10-year yield even lower. So look for about 75 basis points to 1% as the next target for the 10-year.
Sri, that is a phenomenal forecast. If that indeed does happen, does that not do the Federal Reserve's job for it? Would the Fed actually need to cut in that scenario?
Well, you might well ask, what is the Fed doing? What is its function? They think that just because they exist, they have to do something, Vonnie. And they did not do all of the quantitative easing after 2008. The economy would have come back. But they did. And I think that worsened the situation in a number of ways. So right now, as you quite correctly said, even though the market is going to push down the bond yield, they believe that they need to add to the stimulus, and that is quantitative easing. It does not make sense to me either. But we are talking about what the Fed would do, not what would make sense.